Fibonacci retracement strategy explained. This tutorial is going to help you with something that is counterintuitive with Fibonacci retracement numbers and levels. So let's draw it on here real quick and we'll look at what we're doing. So we come up to our drawing tool. I'm using NinjaTrader here in case you're wondering, but most every trading platform has Fibonacci retracements. So go to Fibonacci retracements and we'll draw it from a low to a high. And then I'll extend this out to the right, and we'll see our levels. Now, the big question that people ask, and it's a great question, in fact, if you haven't asked it, you should, and that is, hey, Barry, which of these levels is going to hold on the retracement? So the issue is we've got, all right, so we drew it from here to here. Actually, let me draw my little arrow. So we drew our level from this low to that high. And then as we're coming down, so if we were to come all the way down to 100% of where we started from, 100%, that'd be 100% retracement. And the other levels are 23.6, 38, 50, 62. Okay, we're just going to round off the numbers here. But the big question is, all right, so we've got these support levels, and that's what these are. These are support levels when we're looking for a trend continuation. So we say, okay, we got an impulse move up, retrace, and at what price level, our price levels over here, where should we buy back in if we're going to do a trend continuation? Because just having these lines here doesn't really tell us which one the market is going to stop retracing and then continue in an uptrend this time. It can be any one of these. So we got to add something else because it is true. The Fibonacci retracement doesn't tell you that by itself. It just shows you, well, it's basically support resistance. In this case, it's support levels. So how do we know which one? Well, here is the thing that's a bit counterintuitive. So a lot of people would think, well, look at volume, and what you would probably want to see is volume increasing when the price goes back up. So that sounds reasonable. It really does. And actually, that's one of the things that I considered as well when I first started looking at this many, many years ago. But that turned out not to be the case, to my surprise. So actually, yeah, let's expand this out here a little bit better. So you've got a bigger picture. And we can see the scaling here a little bit better. So what we normally would say is, okay, let's look for volume to come back in, and when it bottoms out and starts to go back up, this bar here, I want to see big volume when price reverses and starts going back up. But as you can see, no, it's a lower volume level, right? Price or volume has been high, and then lower, and then lower, and price goes up on decreased volume. What the heck? And actually, the correct way to identify which level is going to be the final level is to look for the increased volume when price is actually going down. So you see the red bar there, and you see an increased volume, higher bar on volume. And again, use this in conjunction with the price level. And how come, wouldn't you think that if, there's increased volume as the market's going down, you get a red candle, it would break through support? Well, that's not a illogical thing to consider, but here's how it really works. So what's happening is it's an exhaustion pattern on a retrace. Normally we think of exhaustion patterns at the end of a trend, where you might get a big volume spike at the end of a trend, and that signals the end of the trend. And that can happen too. But in this case, we're not getting a big volume spike. We're just getting an increase in volume. But it's the same principle. And so what we're seeing is, when the market comes down and it puts in its low, and the way to understand this is that, okay, the sellers are now capitulating, and now the sellers are coming out of the market. They've sold, boom, and now the buyers can come in. Because, again, remember, the big structure here, the big meta pattern, that's the key to remember in this whole thing, is that we are in an uptrend. And how you read volume in an uptrend, or how you read volume at the end of an impulse move in an uptrend, or how you read volume in a retrace in an uptrend are different things. So we want to, this is actually capitulation to the downside. Okay, people have been selling, and now finally, okay, we've got the biggest amount of selling this whole time. If I go across here, okay, there's been no more selling since from this high all the way down. This is the highest level of selling. So boom, they're out. And again, it comes in line with price. So we're always combining, whenever we trade, we're combining price and time. And that's where cycles come into the market. Very important. You always combine price and time and price. So many people don't do that. They just look at price action alone. And by the way, support resistance levels, these are just price levels. That's why you can't use them with Fibonacci or anything else. You can't use them in isolation. You've got to have another tool. In this case, we're using volume. And I also encourage you to use a pure raw timing indicator, which I give away to all my viewers for free. You're a viewer, so you get it for free. And you can get it right there, as you can see on the screen right now, indicatorwebinar.com. And it's a configuration or a reconfiguration of a common indicator. I show you how to set that up on your charts, works on any charting platform, and how to trade it. So it's about a 45-minute recorded webinar, absolutely free. My gift to you. No proprietary indicators needed. Again, I'll show you how to get it set up on your charts, no matter what chart platform you're using, and how. That's the most important thing. That's why I do it on a webinar, because how to trade it is critical. All right, well, let's get back to how to trade this. So that's pretty much it. We've got to have a support level. And then, so each one of these support levels, we're going to be looking at volume, and then, oh, highest volume in the retrace. Ah, okay, sweet. Now, see, here's what's not intuitive. Oh, when we finally do really go up, we get lower volume again. And now, when it really cranks, we get high volume. But what if we waited till the higher volume bar? Well, now we're all the way up here. And if we buy, when this bar closes and we get the bigger volume bar, there's not much reward left in it. Right? We want to buy down here. We don't want to buy up here. Now our risk-reward ratio's no bueno. And again, just to show how consistent this is, let's look at this retrace here. So there you go again. The big red bar in this retrace, it's the red bar that comes down, comes to the 38.2 Fibonacci level, and big volume bar. Now this one's the highest one in this whole trend. And it's a down bar. It's a red bar. And it holds there. And then if we go back and we look at the green bar, which we would expect, a lot of people would expect, oh, this is where the volume comes in, pushes back up. Nope. That bar has lower volume. And again, it's because the overall direction of the market already has the dominant energy built in, the bullish energy. And what we're waiting for in the retrace, for the retrace to finish, is capitulation of shorting volume. All right, seems a bit counterintuitive, but most of trading is. So there you go. Hope you enjoyed that. If you have any comments or anything you want to add to this, please put it into the comments. Always appreciate that. Also, coming out with some more cool videos really soon. In fact, I'm trying to do 2 or 3 of these a week now. So let me know that you want more videos by subscribing. And that way you also get notifications every time that I come out with a new video. I want to keep you on tap to get these free tutorials and help you improve your trading.